Hey everyone, and welcome back. Today we're going to be taking a look at Thor Industries and their full year earnings for 2019. I know this is a video that a lot of you out there have been waiting for and are excited for, because Thor Industries, of course, is a stock that is in my portfolio and that I've talked about a lot on the channel. And it's also a business that has been falling substantially in terms of on the stock market. So it's certainly going to be interesting to talk about it today. So we're going to break down their earnings, and I'm going to give you my thoughts on the future prospects of the business and what I think about the stock, and sort of, I guess, tackle some of the objections that people have been giving when it comes to Thor Industries as well as a business. I won't be talking about whether or not it's a good investment. I won't be analyzing it in per se in this video. So if you're looking for that, go check out some of my other videos on Thor Industries. There's actually a 1-hour presentation where I break down the entire company. So go check that out if you're interested. But for now, let's jump into their full year numbers, and let's start by looking at their revenue. So revenue for the full year came in at $7.9 billion, which was down from $8.3 billion last year. So down 5.6%. And there's really three major segments that Thor Industries operates under. They have their North American towable RVs, their North American motorized, and then they have their European segment, which is the new segment that has recently been added due to their acquisition of Hamish, which is the biggest RV manufacturer in Europe. So they recently broke into the European market, and that is now a new segment on their operating results. So North American towables were down 24% year over year. North American motorized were down 23% year over year. And then the European RVs, we don't have any year over year numbers because this is a new segment, but it did add 19% to their sales. Now, for someone who hasn't been following the RV industry and the RV market, this looks terrible. Or even for people who are focusing on the short term, who are focusing on the last 12 months, focusing on the next quarter, whatever's happening in the short term, this looks terrible. Their North American operations essentially dropped by 25% from the previous year. But if you've been following the RV industry, then, like myself, then you would know that you need to step back and look at their numbers at a much longer period than 12 months. And the primary reason why is because in 2018, the RV market saw an exceptionally large amount of orders from dealerships who are ordering from wholesalers like Thor Industries. So dealerships ordered too much inventory. And the result was that companies like Thor Industries and Winnebago and Forest River, which is owned by Warren Buffett's Berkshire Hathaway, these companies did exceptionally well in 2018. So if you're comparing 2018 to 2019, yeah, it looks terrible. But that's really just because 2018 was an exceptional year. Now, if you look at any other period other than a 12-year period, you'll notice that Thor Industries' growth has been well into the double digits. You can see that even over a 3-year period, their sales grew at 20% per year. 5-year period, 17%, 14%, 12%, 10%, 8%, 9%, even through the global financial crisis. And we could go on and on and on, 11%, 12% over a 20-year period. So yes, analysts and institutional investors are disappointed that Thor Industries couldn't beat their results from last year. But last year was an exceptionally high year, and looking at the long-term trend, you can see that this is obviously just a year where Thor just couldn't beat their previous year because it was so exceptionally good. But their results were fantastic, and it's fantastic that they were able to cleanly acquire and go through the acquisition of Hamish, and that boosted their sales as well. And in the end, their sales only dropped by 5% from a massively record year, and they posted their second biggest revenue in their history. So let's now look at their earnings per share, and earnings per share came in at $2.47. Now this was down from $8.14, which is down 70% year over year. Now this number is pretty useless, and it's another reason why you've really always got to dig deeper into these numbers. So that number really is useless because it includes a lot of one-off costs that are associated with the acquisition that took place in 2019. So this number is in no way representative of the long-term operations and the continuing operations of the business. So I've gone ahead and removed all of the acquisition-related costs, And the result is when you remove those one-off costs, their earnings per share was $6.40, which is a lot better, but it was still down 21% year over year. Now, again, same as sales, earnings per share was driven down by the fact that we're looking at a comparison between 2018 and 2019, when 2018 was such a great year. And interestingly enough, if you look at just the fourth quarter of 2019, the earnings growth was 0. So it actually didn't decline from this year, from the fourth quarter in 2019, from the fourth quarter in 2018. So the majority of the decline in their earnings came from acquisition-related costs, as well as poor comparisons comparing to 2018 from quarters 1 to 3. And management expects that this should start to improve going into 2020. But again, we will see, and I'll talk about that a little bit more later in this video. In terms of equity came in at $2.1 billion, which was up 8.2% year over year. It's actually fairly unusual for equity to grow in a company after an acquisition, and that's generally because the company has higher levels of debt, they have less cash available, and then they also have all of those acquisition-related costs that reduce equity, reduce their cash pile. So it's actually really impressive that Thor Industries was able to continue to grow their equity through this acquisition. And one of the major reasons why they were able to do this was because they took most of their 2019 earnings, $480 million to be exact, and they used it to pay down debt. And that reduction of debt increased the equity position in the business. This is probably my favorite part of Thor Industries management, is the fact that they have such a focus on paying down debt as soon as possible. In 2016, they paid down about $500 million in debt within under 3 years. So they did an acquisition of Jayco. They acquired Jayco, the RV company, and then they paid down that debt, $500 million approximately, within 3 years. And I don't see any reason why they couldn't do something similar when it comes to the Erwin-Hymer acquisition. Obviously, this acquisition was about $2 billion, so substantially more. But the company is producing a lot more cash than they were in 2016 as well. So they've already paid off $500 million in debt. They have $450 million in cash as well. So they're not cash stricken at the moment. They have a lot of cash. And if they produce a similar amount of cash flow as they have in the past couple of years, they'll probably produce about $400 to $600 million in cash flow in 2020, if it's a similar pace to the past few years. And that basically means that within 2 years, they can reduce this debt by 50 to 75%. So a lot of people are quite scared about the fact that Thor has a lot of debt, but I've looked at management's track record, and I love their track record for paying down debt. They take on debt. They're not afraid to use cheap money in order to make an acquisition, make a smart acquisition. But then they recognize that there's a risk to shareholders if they keep that debt on their balance sheet. So they pay it off as soon as possible. And I have no doubt that they're going to be able to do this in the same way that they've been able to acquire a company and pay down their debt really quickly from many acquisitions over the past 35, 40 years that this company has been operating. The next figure that I want to talk about is cash flow for owners, and this is a figure that's very close to free cash flow, but I prefer to use this figure over free cash flow because it's a better representation of how much cash is available to grow, to return capital to shareholders, essentially, to either grow the business or to pay a dividend. And by grow the business, I mean investing, making acquisitions, making new investments, paying down debts, buying back stock. All of that increases the value of shares. And this figure for Thor Industries came in at $451.2 million for the year, which was up 5.9% year over year. So even though their earnings per share was down dramatically, cash flow has always been a strong point for Thor Industries, and cash flow is ultimately what matters. So while Thor Industries experienced a fair few intangible expenses during the year. So they had to mark down a bunch of their goodwill and a bunch of their amortization, depreciation. None of that really comes across in terms of cash flows because they're non-real cash expenses. So cash flow has always been a good strong point for Thor Industries. And even though they've gone through this year with so many expenses, what they were able to do is, rather than build up their inventory, they were able to run down their inventory, and as a result, they didn't have to build up their inventory and spend cash on inventory, and as a result, they freed up some more cash to pay off a substantial amount of their debt. So of the $451.2 million in cash flow for owners, they used about $73.2 million to expand their manufacturing facility, so investing in the growth of the business. They used $85 million to pay a dividend. They used $120 million to pay down additional debt. And about $180 million was kept as cash on the balance sheet, which can be used to pay down debt in the future. Give them a bit of a cash buffer in case there is some kind of a recession or some kind of economic turbulence within the next couple of years, which is something that very well could happen. So with the 2019 financial year out of the way, what's next for Thor Industries? What should we expect in the future? And the first thing that we should expect as investors is that there could very well be a recession, and there could very well be a peaking in the RV market, and we may see some declines in the number of units that are being sold. So clearly we've seen a substantial decline in the number of units sold from 2018 compared to 2019. Now, whether or not that is the peak of the cycle, or whether it's just that 2018 was exceptionally high and 2019 is a bit of a consolidation, we don't really know. We don't know if it's going to continue to go up in 2020 or whether it's going to continue to decline, and this is actually the end of the cycle, and we're actually going to see substantial declines in the number of RVs that are purchased in the retail and in the wholesale market. Now, in terms of where Thor gets their data from, their forecasts in the industry, they get a substantial amount of their data from a company called RVIA.org. And they actually believe that in 2020 and in 2021, they believe that the number of units sold are going to continue to decline. So they believe that this trend is going to continue. Now, remember, this is just a forecast. We have no idea what the spending habits of people are going to be in 2020, but that is the prediction made by the company that basically studies and tracks the movements of RV purchases in the RV market. Now, that data refers to the US and North America only. So that refers to North America only. Remember, Thor Industries now controls a substantial amount of the European market, about 20 to 25% of that market as well. And in terms of the European market, despite their economy seeming weaker, the RV market is continuing to be strong. It's growing at a relatively even pace at about 3, 4, 5% per year. That's the retail market, which is essentially the driver of the wholesale market. So in the European segment, it looks like their cash flows are going to continue to grow. In the North American segment, it's possible, and it looks as though, according to this research firm, that Thor Industries is going to start to see some continued declines in 2020. But in terms of Thor's management, they are saying that they're seeing some positive things out in the market. They're saying that it's also very likely that the industry and Thor Industries continues to grow in 2020. And why I'm giving both of these sides is because no one really knows, and ultimately I don't really care. I don't really care what's going to happen in 2020. And I may as well touch on this now, is that many people believe that because Thor Industries has been declining over the past year or 2 years, that I would be really upset about that. And at the same time, those same people would think that because Thor Industries went up 15, 16% on their full year earnings, that I would be really happy about that. But I don't fall into either of those positions. I am super happy to see Thor Industries stock fall. And why is that? Because I'm buying it. Because I'm a net buyer. I'm 21 years old. I'm going to be buying this company for at least the next decade, if not the next 2 decades, because it's a great business that I want to invest in over my lifetime. Now, why would I want to see the stock price of a business that I'm going to be buying go up? I don't want to see it go up. If you're going to the shops to buy a new t-shirt, you don't want prices to go up. You want prices to go down as far as possible. And that is the case with my investment in Thor Industries. I didn't want the market to like their full year earnings. I'm actually a little bit disappointed that it didn't go down 15% because I wanted to make a further investment, and I want to continue to make investments in the future. So obviously I want the company to succeed over the long term, and I think there's no doubt according to my analysis, remember, this isn't a recommendation or anything. This is just me sharing my opinion on the business and through my analysis. I think there's no doubt that the business is going to be highly successful in the future. It's just a matter of what is going to happen in the short term. If we have a recession, their earnings and sales are going to continue to decline. If there isn't a recession, then this cheap financing that's available, low interest rates, may fuel more purchases in the RV market and may return the business to growth, and that would actually result in the stock price exploding, which is ultimately what I don't want, because I want to continue to buy this stock while it's down. Now, I don't want to jump in too much into the analytical side in this video. If you want to see me analyze Thor Industries, as I said, there's a 1-hour presentation broken down into 2 videos on my YouTube channel, so go check that out if you're interested in seeing my full analysis. But I just wanted to show you some estimates of how much cash we can get out of this business, and just to show you how conservative you can really be and still expect to make a decent return on this business. And I want to show you why I am investing in this company and why I really don't want to invest in anything else, because there's really nothing else that I can see in the market that is offering me such a good risk-reward relationship when it comes to this business. Now, there are a lot of people out there. Before we get into the valuation, there's a lot of people who believe that Thor Industries is the kind of business that's a value trap. And I want to make this clear. I spoke about this in another video as well, but I want to make this clear. A value trap just simply means that you're buying a business because it looks cheap. Maybe it has a low price to earnings ratio, but it's actually got a low price to earnings ratio because their earnings are going to drop substantially. But essentially what a value trap means is it's just when a business looks like it's cheap when it's not. But if a business is great, it can be a value trap at one price up here, but if the price falls 80%, then that same business, if it's a great business, might no longer be a value trap. All we're trying to do is find a price that makes sense compared to what we're going to get out of it. And with businesses that are cyclical like Thor Industries, the best way to protect ourselves is just to be really, really conservative in our estimations. Expect the bare minimum out of the company in the future. And then as a result, we will be paying a really low price relative to their future cash flows. So check out some of these valuations that I've done to show you how conservative you can be and still get a decent risk reward profile out of a business like this. Now, over on the left at the top, you can see I've got year 0. So this is the cash flow I've got from this year. Now, for 2 of the models, I'm using this year's cash flow for owners. So this is the cash flow that was returned to owners in 2019. That's 451 million. These are in millions. And you can see I'm also then using 3 models that use the average cash flows of this business over the past 10 years. So this is an average, 225 million. So I'm assuming that, well, in this first model, I'm assuming no growth. So I'm assuming that they don't even continue to produce the same cash flow as they are at this level, but they drop down to the average and their earnings never grow anymore. And remember, this is a company that's grown their cash flows at a 17% compounded rate over 25 years. 17%, okay? And we're assuming 0 growth, and we're assuming that this is 0 growth from an average, not even from their current cash flow. Now, under that model, I've entered in a required rate of return of 6%, and the buy price is at the current stock price. So that means that 6% is the expected return. So if this company's earnings drop down to their average over the past 10 years and they don't grow, remember, they just acquired 20% of the European market as well, and the US market is continuing to grow, we would still make a 6% return. Then we go up a little bit less conservative. We assume that they grow at 3.71%, which is the long-term growth rate of the RV industry. This is what the industry has grown at over the past 20 years. Now, if we assume that, and we enter in a required rate of return of 10, you can see that it equals the current stock price. So assuming just 3.71% growth from the average cash flow that they produced over the past 10 years, we will get an expected return over the next 10 years of 10% per year. So again, super, super low. If we then up it to 16%, we can see the middle model suggests that it's the current buy. So even assuming 10% growth, which is still less than their long-term average over many, many cycles, and using an average cash flow of 225 million, then the expected return is 16%. And we can take this all the way up to a top model, which uses their current earnings and grows it from this point at 10% per year, which is a big ask. This is a big expectation. It's not something that I feel confident will happen, but I think it is something that could happen because it has happened in the past for Thor Industries. Whether they do it again is not probable, but it's possible. But if we enter in a 28% required rate of return, you can see that under the fifth model, the buy price is the current stock price, which means that under that model, if they grow at just 10% from their current earnings, which again, as I say, is possible, not probable, but they've done it before in the past, then you would make about 12 times your money over the next 10 years. So just to summarize all of that jargon, in case some of you didn't follow that, at the low end, at the very, very low conservative end, investing at the current stock price, I estimate that you would double your money over the next 10 years. And at the very, very top end, and this is super out there, but is possible, that could happen, you would 12 times your investment over the next 10 years. Now, that is the kind of risk-reward profile, risk-reward balance that I'm looking for in businesses. On the low end, at the very least, I'm still going to make a decent return, 6% per year. Much better than a savings account. At the high end, I'm going to massively grow my investment, a $10,000 investment into $120,000 over a 10-year period. And that's what I'm looking for when it comes to investments in the stock market. And that's exactly what I talk about all the time on the channel, finding businesses that offer that kind of risk reward. And I know this video has gone on for a really long time, so thanks everyone who's stuck around and is still here. But one more thing I just wanted to mention, I think that a lot of people believe that I've kind of lost my shirt when it comes to this investment. And I think the reason why they think that is because I wasn't very clear about my buying habits of Thor Industries over the past couple of years. And that's my fault. I think a lot of people think that I invested a lot of money when the stock price was maybe 80% higher before it had dropped 80%. But that's just not true at all. I did start investing, and there are some investments that I made that dropped substantially, 50-60% from those investments, but more than half, more than 50% of the shares that I hold now were bought at a price less than $60 per share. So the vast majority, and I want to make this clear because I don't think I've made it clear in the past, the vast majority of my position in Thor Industries has been purchased at a stock price of less than $60 per share, which is basically what the current stock price is now, maybe down 4 or 5%. So I want to make that clear. When I've been investing in this company, I've liked the business for a very long time, but I haven't loved the price until more recently, until the last year. About the last year, it started to drop below $60-$70 per share, and I started to get quite aggressive with my investments. But I would ultimately like to see it hit $35 or $40 per share so that I can make some big, substantial investments. Because ultimately, if I bought a certain amount of shares at $70 per share, then I can make the same investment at $35 per share and buy twice as many shares. And that's ultimately what I want to do. I want to acquire as many shares as possible before this business and the industry return to growth. And then I can experience and see what kind of growth we can get out of Thor Industries. But I won't take up too much more of your time. So thanks everyone. I really appreciate it if you stuck around and listened to this. If you did enjoy it, as I said, hit the like button, hit subscribe, let me know your thoughts on Thor Industries or any other companies down in the comment section below. But I hope you guys have a great day, and I'll see you in the next video.